The worksheet is a tool that helps accountants who work in a manual rather than a computerized accounting environment prepare a trial balance, adjustments, and the financial statements. It is quite rare to prepare a manual worksheet, but it's not unheard of even today. Just a few years ago, I worked with a company where the owners wanted all accounting records maintained in Excel because they knew how to navigate that program. The preparation of the worksheet, the fourth step in the nine-step accounting cycle, helps speed up the process of preparing financial statements and ensures the timeliness of the financial statements in an environment where manual accounting is used. That is quite rare these days, though. If the company has accounting software such as QuickBooks, Sage, NetSuite, or SAP, the manual preparation of the worksheet is no longer necessary. Instead, the adjustments are entered as general journals with a specific code that identifies these journal entries as adjustments in the accounting system. And the accountant can then generate the worksheet or the adjusted trial balance by running a report from the system. In this video, though, we'll cover the manual preparation of the worksheet, and we'll do so by using our textbook's example of Eli's Consulting Services. That's what the worksheet looks like. At the top of the worksheet is the header, which shows the name of the business, Eli's Consulting Services, on the first line. On the second line is the name of the document, the worksheet. And on the third line, the time period. In this case, the month ending December 31st. The worksheet has multiple sections, the account name in the first column, the trial balance, debit and credit columns, the adjustments section with the debit and credit column, and the adjusted trial balance, which is calculated by taking the amounts from the trial balance plus or minus the adjustments. The last two sections are for the income statement and balance sheet. Just a reminder that the worksheet is not a formal financial statement. It's only a tool used by the accountant to eventually prepare the financial statements. And because we're learning the manual process for accounting, you're preparing it. However, in a company with computer software, the system would generate it for you. So let's look at it step by step. The worksheet begins with the accountant transferring the information from the general ledger accounts into the worksheet. Enter the account names into the account name column and the debit amounts from the general ledger accounts into the debit column and the credits into the credit column. Accountants often know that they will need additional accounts that are not yet listed on the trial balance, like, for instance, accumulated depreciation and depreciation expense. So the accountant already enters those account names, even though they don't yet have a balance. If that sounds a little confusing, it will be less confusing as we work through the example. Then the accountant tallies up all of the amounts in the debit column and credit column of the trial balance section. And if you've done everything correctly, meaning you transferred the amounts correctly, the total debit should equal the total credits. At the end, you place a double rule under each trial balance column to show that the work in that column is complete. So let's do that together. So first we'll enter all of the GL account names for Eli's Consulting into the account name column. Here I've already added 4 new accounts that I know we'll need later because we'll need to record adjustments that impact these accounts. These accounts are accumulated depreciation, supplies expense, rent expense, and depreciation expense. You might need additional accounts if there are additional adjustments to record, and you can either leave enough space to write in the names of the accounts that you'll need later, or you can add them at the very bottom. The next step is to look at each general ledger account and transfer the balance like I've done here for the cash account. The cash general ledger account has a debit balance of $111,350, and we'll transfer that amount to the debit column of the trial balance. Then we'll complete that process of transferring the general ledger account balances for all of the other general ledger accounts. In step 3, we'll enter all the debit and credit column amounts into the trial balance section and add up all of the amounts in each column. You can see that the debits equal the credits in the trial balance column because both columns show $150,500. If the debit column does not equal the credit column, you've likely entered a general ledger balance into the wrong column or transposed a number. As a starting point, I would look at the difference between the total debits and the total credits and see if that number is divisible by 9, which would mean you transposed a number. If you can't quickly see where you made a mistake, you will have to go back and look at each general ledger account to find the mistake. You can't proceed with the adjustments until the debit total equals the credit total. Once it does, we'll place a double rule under each trial balance column, which is step 4, to show that the work in that column is complete. We're now ready to start with the adjustments in the adjustment column of the worksheet. Eli's Consulting began the month with $1,500 in supplies. How do we know that? We can look at the trial balance column and we can see the supplies account listed with a $1,500 amount in the debit column of the trial balance. Many companies choose to not record supply costs as an asset because the amount is below the company's materiality threshold. Sometimes, though, parts can be very pricey and perhaps cost $50,000 and more per part. That's a material amount, and unless the company uses this supply part rather than keeping it in reserve, it should remain on the balance sheet. For Eli's Consulting, we learned that at the end of the month, $1,000 worth of supplies are remaining, which means that Eli's Consulting used up $500. When accountants say something was used up, it means that it is now an expense and no longer an asset. So how do we record the usage of the supplies? We need to transfer $500 out of the supply account to supplies expenses. Let's figure out the debit and the credit for this transaction. First, what account increased and what account decreased. First, supplies expenses have increased, and supplies expense is an expense account, and just like assets, expenses increase with debits. That means we need to debit the supplies expense account. The supplies account on the balance sheet now has less supplies. The supplies account is an asset, and assets increase with debits and decrease with credits. So we need to credit the supplies account for $500. Before starting with the next adjustment, make sure that you've entered both sides of the adjustment into the worksheet. On November 20th, Eli's Consulting Services paid $8,000 for the December and January rent. We recorded it as a prepaid rent, and we can see the account prepaid rent is still showing $8,000 in the trial balance column. As of December 31st, Eli's Consulting has used up the rent for December, and we now need to record it as an expense. Why? Well, the December rent portion is no longer an asset because Eli's Consulting has used the building the entire month. Let's analyze this transaction. We now have more rent expenses and less prepaid rent. So rent expenses increased and prepaid rent decreased. Rent expense is an expense account, and expense accounts increase with debits. Okay, so we need to debit rent expense. Our prepaid rent decreased, and prepaid rent is an asset account, and asset accounts increase with debits and decrease with credits. The prepaid rent account decreased, so we need to credit the prepaid rent account. We recorded the December portion in the worksheet by entering a $4,000 debit into the adjustment column for rent expense and a credit into the adjustment column for prepaid rent. This is a very typical adjustment accounts make at month end. There's prepaid rent, prepaid insurance, prepaid trade shows, prepaid subscriptions, and so on. And each month, the account makes an adjustment entry to record that part of the prepayment that has now expired and becomes an expense. The next adjustment is for depreciation. What is depreciation? It's the process of estimating how much the company's assets have lost in value month over month and year over year. It's not that different from supplies that were used up and expired prepaid rent. You just estimate the amount that's been used up. Imagine if a large company would actually have to assess how much value each of their assets still has. So we use different methods of depreciation and estimated useful lives to approximate how much value an asset still has. Is it super exact? Absolutely not, but it is a good guesstimate. So let's cover the different methods really quick. There is straight line, declining balance, sum of the year's digits, units of production, and double declining balance method. The IRS also requires the use of a depreciation method called MAKERS, unless it is an asset purchased before 1987. For Eli's consulting services, however, we will use the straight line method of depreciation. The straight line method spreads the purchase cost less salvage value in equal portions across the estimated life of the asset. Salvage value is the amount that you expect to sell the asset for at the end of its life. Now let's talk about the estimated useful life. There are different ways of calculating the useful life, but there are also guidelines that are issued by the IRS. Many companies use a standard of 5 years for furniture and fixtures, 10 to 20 years for manufacturing equipment, and perhaps 3 to 5 years for computer equipment. Two more things to mention before we calculate depreciation for Eli's consulting. Generally accepted accounting principles require that the original cost of the long-term asset continue to appear in the asset account until the asset is disposed of via a sale or thrown away. That means that the depreciation we record does not reduce the asset account directly. Instead, we'll use a contra asset account called accumulated depreciation so that we can see both the original purchase price of the asset and the depreciation we have recorded since the purchase. Now we're ready to calculate the depreciation for Eli's consulting equipment assets. Eli's consulting services purchased equipment in November for $11,000. The useful life is 5 years. The salvage value is $0. And Eli's consulting services uses the straight line method. So to compute the depreciation for the month of December, we subtract the salvage value, which in this case is 0 from the cost of the assets, leaving us with $11,000, and then dividing that amount by 60 months, which is 5 years a month. The amount of the monthly depreciation is $183. As I mentioned previously, depreciation is not recorded directly as a reduction to the asset account. Instead, we are now using a new account called accumulated depreciation equipment, which is also called a contra asset account and has a normal credit balance, even though it's an asset. An additional term that is often used in connection with assets is the book value. The book value is the net asset value after depreciation, which means that you take the original cost of the equipment and you subtract the accumulated depreciation from it. In our case, it is $11,000 minus 183, which equals 10,817 in a book value. To find the debit and credit for this transaction, we analyze the transaction. We now have more depreciation expense, which is an account in the expense category. And expenses increase with debits. That means we have to debit depreciation expense. The second part of our transaction is that we now have more accumulated depreciation, which is a contra asset account. This is a bit tricky because this account behaves in the opposite way of an asset. Asset accounts increase with debits and decrease with credits. Contra asset accounts increase with credits and decrease with debits. So we credit accumulated depreciation. Let's now enter the depreciation into the adjustment column of our worksheet by debiting the depreciation expense equipment account for $183 and crediting the accumulated depreciation account for $183. Don't forget to calculate the total debits and credits for the adjustment columns and double check that they are the same amount. Next, we complete the adjusted trial balance columns by adding the amounts in the trial balance column and the adjustment columns. Only the 6 accounts from the trial balance columns that had adjustments now have a new amount in the adjusted trial balance columns. All others remain unchanged from the trial balance columns, like for instance, the cash account. The balance in the trial balance columns was $111,350. There was no adjustment in the adjustment column, and therefore the amount in the adjusted trial balance column is $111,350. On the other hand, the supplies account had a debit balance in the trial balance of $1,500, but a credit in the adjustment column, which reduces the remaining debit balance to $1,000. When you've completed the adjusted trial balance amounts for all accounts, total both columns and ensure that both debits and credits are the same. Next, we'll sort the amounts in the adjusted trial balance columns into balance sheet accounts and income statement accounts. We enter the balance sheet amounts into the balance sheet columns and enter the income statement amounts into the income statement columns. All the accounts from cash to Trayton Eli drawing are balance sheet accounts, whereas the fees income to depreciation expense are income statement accounts. There's a special step at the end after you've completed the income statement and the balance sheet columns. You total the columns, but they won't equal. Do you recall that we said that all of the profits, or losses for that matter, belong to the owners of the business? That is why we have to transfer the profit for Eli's Consulting first to the balance sheet for it to balance. You start first in the income statement columns by subtracting the expenses from the fees income and enter the net income amount into the debit column, and then you total the columns. You also enter the same amount, the net income, into the balance sheet column as a credit, and when you total the balance sheet columns, they should balance as well. Is that it? Not quite. The next step is the preparation of the financial statements, and we also need to journalize the adjustments and post them to the general ledger.